Hello and welcome to our discussion on frequently asked questions in accounting series. In this series, we pick up few questions and try to understand the effect on the financial statements. The focus of this session is to understand amortization and understand the effect of amortization on the financial statements. Amortization is the allocation of intangible asset or the cost of intangible assets or deferred revenue expenses over a period of time. Allocation of cost of intangible assets or deferred revenue expenses over the period of time is as per the matching principle of accounting. The benefits given by the intangible assets, the period of benefit of intangible assets is used as a basis for allocating the cost of the asset. Therefore, a part of the cost of the intangible asset is charged to the income statement and the balance is shown in the balance sheet. So whenever there is an amortization, in the balance sheet the intangible asset is reduced to the extent of amortization. In the income statement, amortization is shown as an expense, and cash flow statement there is no direct effect of the amortization because amortization is only allocation of cost. Let us take an example to understand that. So there is a balance sheet given, some transaction, very few transactions given to keep a focus on the amortization. So opening cash, the opening cash in hand is 70,000. You are purchasing the know-how. Purchasing know-how for 60,000 is a cash flow, and know-how is an asset. Know-how is an asset to the extent of 60,000. And entire stock is sold, so sales during the period is 100,000. And let us assume that entire sales is for cash, so entire sales is for cash. And whenever there is a sales, there has to be cost of goods sold, so cost of goods sold becomes an expense, so the stock is 50,000 and stock will reduce to the extent of 50,000. No other expense there. Amortization, as it shows, the amortization is 20,000 for the year, so we show 20,000 in the income statement. And to the extent that of amortization, the value of the know-how is reduced to the extent of 20,000. So amortization shown in the income statement, and the know-how, the intangible asset, is reduced to the extent of the amortization. And we show the total expenses. Total expenses is 70,000. The PBT is equal to 100,000 minus 70,000. For the time being, we'll ignore taxation, so this is not important at this juncture. So assuming that tax is not there, so we have the PAT is equal to 30,000 minus 0, the tax, that is 30,000, and we transfer entire PAT to the reserves. So income statement is done. The cash in hand is 70,000, 170,000 inflow minus 60,000 the purchase of know-how. So cash in hand at the end of the year is 110,000. So cash in hand is 110. No change in the capital, no change in the creditor, no change in the creditor, and no change in the debtor. So therefore the total of assets will be 200,000. So we can see that The focus of this session was on the amortization. The amortization is shown in the income statement to the extent of amount amortized, and the value of the asset is reduced to the extent of the amortization, and the purchase of know-how or intangible is shown in the cash flow statement. So know-how, which is an intangible asset, is reduced to the extent of amortization, and there is no direct effect of amortization on the cash flow, but cash flow is affected to the extent of know-how purchased. To recap here, the balance sheet, because of amortization, the intangible reduce. In the income statement, it's shown as an expense, and in the cash flow statement, no effect.